My name is Jonathan Goforth with Platinum Realty. I've been a full-time real estate agent for 28 years. We're going to talk about the market right now and how we got here, and we're going to try to forecast where we are going next over the next year. And it's hard to do that. You know, if anybody could actually do this with 100% accuracy, then if I could, I'd move to Vegas and I would be very rich if I could predict things. But we're going to look at what's going on. We're going to kind of examine it, and we're going to forecast it. So in the last 28 years since I've been a full-time real estate agent, you know, I got to go through a 9/11 back in 2001. And there were a lot of stimulus packages that came out of that quickly because there was a lot of fear that our stock market could collapse, our real estate market could collapse, the economy could collapse, there could have been mass layoffs, we could have gone into a depression. Who knows what could have happened? And so the government issued a lot of stimulus packages coming out of 2001, you know, Homeland Security, and there's a lot going on. There was a lot going on in 2002 and 2003, and a lot of it spurred on what became an explosion of growth and an explosion of a really good economy leading into 2003, 2004, 2005, and then 2006, the housing market peaks. What I think back then was the best housing market ever, because there was so much growth, so much new construction, shopping centers being built, schools being built, the suburbs are growing like crazy, but a lot of that was spurred on by bad loans. Now, we don't have those now, and you're not going to see any mention of bad loans like we saw back in 2003, 4, 5, and 6. Interest-only adjustable ARMs was a lot of it. And back then, those adjustments were huge. So what happened, let's say it was a 3-year adjustable ARM taken out in 2005 during the peak of the explosion of housing. But 3 years later, as those rates would adjust to a much higher rate, people couldn't make the payment. And that took us into 2008, and the market was collapsing. And that took us into what became a crashed housing market. And back then, 2008, 2009, the market was crashing. It was really bad. And yes, I was a full-time real estate agent back then. And then we finally hit the bottom of that in 2010, and we held there for a long time. We held there in that really bad market. There were, at one point in time back then, there were over 1 million foreclosures on the market at one time. Now, you're not going to see that on here, but we're going to talk about some other things. And then over time, you know, the market exploded again, and it rebounds, and it starts growing again, and that takes us up into a really strong seller's market in 2017. 2018 is getting bigger. 2019 is a very strong seller's market. We have very low inventory, and boom, 2020, and COVID hits, and the worldwide economy shuts down. And out of that, we are now 5 years after the beginning of COVID in 2020, and we are now suffering from inflation. 5 years of this horrible inflation, the highest inflation rates ever when it comes to a lot of things that we really need, like food, and the cost of construction. And you probably noticed that your homeowner's insurance has been skyrocketing over the last 3 or 4 years. And the same with car insurance, auto insurance. This is one of the big factors that we need to be worried about right now. The inflation of new construction home prices. And really, I don't know if you've gone to look at new construction. Go out to your suburbs where the brand new homes are being built, and just walk through some of those model homes, and you're going to see they are smaller than they were 5 or 6 years ago, especially 10 years ago, because the cost is so much higher. A lot of these are probably ranches. They're going after the baby boomers, and I think the construction is not nearly as good of quality. They've cut corners to try to get control of these out-of-control construction prices. And you're going to be in shock what you get right now for $800,000 of what you get out there right now, new construction for $1.5 million. These prices are crazy. The homes are kind of small. And on top of that, do you know right now what interest rates are? Here's what's interesting about it. You know, people will say, because I've been doing this 28 years, I'm not new at this, but people will say back in the 80s, the rates were crazy. They were much worse. And we all sold houses. The difference right now, it's not just that current interest rates are so much higher. They're too high compared to where we were just 3 years ago. You know, I refinanced my home just three and a half years ago for around 3%. And a lot of the nation did. So many people refinanced during COVID into these really low interest rates. They may be locked in right now at 2 3/4, 2 7/8, 3 1/8, 3 1/4 on a very widespread basis of our population. Why would anybody in their right mind sell that house and go buy another house and pay 6%, 6 1/4, 7%, 7 1/4? Why would anybody do that? And that's part of our problem right now. Too many people will not let go of their current mortgage. They're not going to go buy another house and double their rate, because that's not what we saw in the 80s. We didn't see a rapid increase in interest rates over an 18-month period. And that's what we have seen. Part of the problem, and this was a problem caused by holding the rates too low for too long. You know, when the rates hit and they just kept going down and going down, but they didn't need to do that. We had the strongest sellers market ever in the history of U.S. housing during COVID. It was so crazy. You know, before that, we never had a document called it's an escalation addendum. And with this kind of a escalation clause that you could add into your buyer's contract to help sweeten the deal of your offer, you will tell the seller, now this is when there's multiple offers, you will tell the seller that you will beat the highest offer they have by a certain amount, maybe $1,000 more or $2,000 more than the highest offer they have, up to a certain price. I mean, you're not going to leave that open-ended, but up to a certain price, you will pay more than the highest offer they have. And we use that form, and to an extent right now we still do on occasion, not nearly as much as we did 2 years ago, 3 years ago, and 4 years ago, because our market's changing, it's shifting, and it's definitely slowing down. Now the question for you, are we looking at a crash? Because there's a big difference between a slowdown and a crash. Right now we also have economic uncertainty, which is kind of funny when you see our stock market. You know, today, here we are coming into the we're on the back half of July. August is approaching, and we have the stock market resetting another record high on the S&P 500. It's another all-time record high. You have the NASDAQ, also very, very high. You've got companies like NVIDIA constantly climbing and climbing, and yet with that, there is economic uncertainty. Where might we be 3 months from now, 6 months from now, a year, 2 years from now? And it makes people nervous. Why would people want to buy a much more expensive house, get rid of their current house and let go of this low rate to now lock in with a brand new rate that's much higher than what they're going to let go of if they're nervous about the economy? You know, massive government layoffs have certainly caused some concern for that. But we look at this. We look at what is going on right now over the last month or two. Now, this is the new one that has happened in the last month. We have bigger builder incentives on the new construction. If a builder is sitting there on some spec homes, and you know, I live here in the Midwest, and we tend to follow what happens in Florida, California, and the East Coast. We tend to follow that. We're always a few months behind. So this has already been going on in those more populated states. Builder incentives, because builders are sitting on spec homes. They're sitting on inventory. A spec home is a speculation. It's where they're going to build a home without a buyer. They're going to build it, and of course it's listed along the way, and they take it to a certain point, hoping the buyer comes along soon, so the buyer can now pick out paint colors and maybe the granite and the tile choices that they want. But at this point, a lot of these homes are finished, and the builders are sitting on this inventory right now, and they are building, or they are having to pay, the builders are having to pay interest on these loans. So now, for example, there's a local builder here that's a big builder, and they have done some of their specs that are sitting there too long, $40,000 price reductions this week. In addition to that, an additional $10,000 towards the buyer's closing costs, and they can use that for a rate buy down because they know this is a problem right now. It is hard to get a lot of buyers out there to let go of their current rate. So they're not going to sell their house. And so if the builder now is becoming desperate, is what this is. This is a desperate move for a builder to unload some of their inventory. So they will offer incentives for the buyer to buy down the rate to help it not hurt so much. If you can get that 6.5% rate to come down to 6 or into the upper 5s. They're also offering maybe free blinds. You know, blinds do not come with new construction. And you get maybe some appliances, but you don't get a free refrigerator typically, or certainly not a washer and dryer. They're tossing these things in for free. This started happening on a much bigger scale this week in July. We're also seeing for the first time in years that builders are reducing the prices on their spec homes. This is an indication that the market is slowing down a lot. Which is interesting because we have a lack of inventory. It's hard to find good houses to go buy, which is another problem. Let's say I have a buyer who is willing to let go of their rate. They want to buy a house. Let's say it's somebody a little bit older, and they're living in a 2-story, and their knees hurt. They're looking at knee replacements, maybe a hip replacement. They need to let go of their 2-story, and they need to buy a ranch. The dilemma for them is, where do they go find a good ranch? Because if they look at the resale market, the older we go, it might need a new roof. It might need a new furnace and air and carpet and paint and on and on and on. The house in general is just dated. Why would they let go of their house to buy a dated house that now they have to remodel? So they're looking at new construction. But there's a shortage of really good homes on the market. And the last thing they want to do is get a home that's a lot smaller and so much more expensive due to these out of control inflation costs. And now you can see the dilemma we're in. We have a lack of first-time buyers. It's bad. It's not just a lack of them. You know, a couple of years ago, there's articles that talk about it is the slowest amount of, the fewest amount of first-time buyers since the 1950s. It is that bad. And so you're probably seeing a trend, and we're going to talk about this trend. Why do we have such a lack of first-time buyers? Because this is a problem. We need lots of first-time buyers to be constantly entering the market so that those sellers can scoot up and everybody can keep advancing into different homes. Why? Because this is part of our problem right now, and this problem is not going to change anytime soon. And am I concerned? Yeah. In fact, I was going to wear a patriotic tie with this because this is the American dream. It's owning a home. That is the American dream in the United States, is owning a home. And then you take the equity out of that home after a few years and you buy a bigger home. And you pay that down a little bit with your mortgage, and then you take the equity out of that and you buy another home, a bigger home. And next thing you know, it is loving the American dream. And then someday, this beautiful home you have gets paid off, and you have a very nice asset that is paid for, your home. But with a lack of first-time buyers, that means they are not buying homes. What are they doing instead? They're renting. And so what do we have going on in the suburbs? You should just go drive around different suburbs of where you live in your metro area, and you are going to see lots of apartments being built. There's probably large complexes. You know, where I live in a suburb here in the Midwest, and there are more apartments being built than homes. And that's not a good sign. That's because these developers know there's a lack of first-time buyers. But there is an all-time high of first-time renters. These buyers, these young people, would rather rent because they've been priced out of the market. That is their problem. They have been priced out of the market. And a lot of you who are looking to buy a brand new constructed home, this has been your dream. You want brand new construction. You go out there and you go to the parade of homes and you look at what you're going to get and you're like, I'm not going to do that. I can't afford that, and I'm certainly not going to buy that. It's small. It's kind of cheaply built. I'm not impressed with how it looks, and this is why you see builder incentives now to unload what they have. And in addition to that, we don't even have that much new construction going on. Nothing like we had back in 2003 and 4 and 5 and 6. We had a lot more new construction back then for home sales. What we have now, rentals. Massive apartment complexes because buyers to buy a home have been priced out of the market. And there is a perception that it's more economical to rent. And it doesn't matter if that's true or not. That's the perception. And so what you should be doing, if you're smart, is buy rental properties. That's where you should be investing your money. Buy rental properties if you can get a deal, which is hard to. And if you can cash flow and, watch your numbers, because if you're going to get a loan on that rental, your rate is going to be higher. So make sure you allow for this higher rate. Rates are even higher on investment properties than they are for purchases if it's going to be your primary residence. But yes, there is definitely a perception that it's more economical to rent. Everything is done for you, especially a lot of young people I've noticed in the last few years. There's a different kind of mindset for young people. I think a lot of people who are young would rather not have a normal 9-to-5 job. I think they would rather do DoorDash and Uber. And you can make a lot of money doing that. But there is a mental change, which is really sad because home ownership is really where it's at long term. It really is. It's these first-time buyers buying young in your 20s and start building wealth. You don't build wealth when you rent. You are helping the landlord build wealth. And so now the question is, and I want you to post comments, is the housing market going to crash? Is this the recipe to make it crash? This one I will tell you is a concern. If you built your home in the last 4 years, you live in a new constructed home, and you have other homes right now, lots in your neighborhood that are being built on, you might find yourself upside down pretty quick. If these builder incentives get worse and they start doing more price reductions, more money towards these buyers to get them to come in for the rest of your neighborhood, and you paid top dollar 3 years ago, you may find that to build your same home might be cheaper because builders are trying to unload the spec homes in your neighborhood if you have that going on. We do have that going on here in the Midwest right now. And we've got a house, for example, listed in a neighborhood that's it's about 2 years old. We have reduced it 3 or 4 times right now, trying to get it to compete against the new construction, because the new construction, one of these builder incentive things going on, is on the same street. We can't compete with that. People would rather have brand new construction if they can afford it. They're not going to come in and buy you somebody else's used dream home when they can get pick out their things. I don't think the market's going to crash. This is not the recipe for a crash. My answer is no, but it is slowing down, and we are seeing widespread price reductions. I think going into 2026, we're going to see property values fall a little bit. I think the rest of 2025, I think the market will be flat because we are priced a little higher than we were last year. So I think as these price reductions come through more and more on a widespread scale, we're going to see a flat market, and that will eventually turn into continuing to slow down until we go into 2026. And if things like this keep happening, more and more price reductions, those become the comps for the future listings that come on the market. Now, that's just where we are right now. That's a lot of it. And this varies from region to region. You know, some states are hit harder with this. The one big thing that we don't have widespread are layoffs. Now, I know there's been a lot of government layoffs, but for businesses, we don't see layoffs right now. The job market is definitely slowing. But if we add layoffs into this, then that dramatically changes this. So if we start seeing a lot of layoffs, this is what we saw in 2007 and 2008 and 2009 and 10 and 11. We saw mass layoffs. And the problem with that, people can't make their mortgage payments. And then we start seeing foreclosures. Now, right now, we don't see widespread foreclosures. That's not on the list. It's not part of this. But if it becomes part of this in a year, then this dramatically changes this equation. And then, yes, we start looking at a dramatic decrease in the housing market. And at that point, we could look at a housing crash, a housing market crash. We do not want to see a real estate crash because it's devastating to everything. So much of our economy is based on the housing market. In particular, people forget that county taxes, which nobody wants to pay, but the biggest portion of what those county taxes go for are schools. And if property values start falling a lot, so does the tax revenue that comes in to fund your schools and your county programs. And we don't want to see that happen. We did see that happen when the market crashed the last time. Put your comments below. Do you think it's going to crash? Do you think it's going to just slow down? Do you think it's going to turn around really fast and this is nothing? Am I overreacting? Am I underreacting? I want to hear your thoughts. Put your comments. Because I will say this. What you think is more important than what's really going on. It's the perception that drives all of this. It's the perception. It's the perception that people don't want to let go of their current rate. Could they afford it? Sure. Of course they could afford it. It's only 6.5%, maybe 7%. But compared to the perception of letting go of your rate at 3.25%, people don't want to do that. And that's where the problem comes in. Is it smarter to rent than own your own home? No, it is not. You never build wealth doing that. You never build wealth. You never advance into something bigger and bigger and bigger over the next 30 or 40 years of your best years. And that's why it's so important for you, all of you watching this in your 20s, buy a home. Invest in yourself. Don't invest in the landlord. But the problem we have is the perception is that it's more economical to rent. And some of these complexes, I'll tell you, you get a gym, you get a pool, you might get garages, but you're going to have to pay extra for the garages. And people have the perception that it's good to do that because everything is taken care of for them. And that's a different mindset with a lot of today's buyers. That's why we see pretty much a record low number of first-time buyers entering into the market. This will create a problem over the next few years. Without these people building wealth, where else are they going to build it? So anyway, thanks for watching. Thanks for watching so much. Please post your comments below. If you've never subscribed to me, please subscribe, give this video a like, and check out my other videos.